Hey everyone, and welcome back to another portfolio update for you today. So over the past week, as you can see, performance-wise, we're basically flat. But yeah, the moves, of course, were quite volatile. At one point here, we were down 3.7%, whereas the S&P 500 was down 0.83%. Year to date, we are still up 36.4%, whereas the S&P is up 10.11%. And since the start of the portfolio, we are up 117.7%, whereas the S&P is up 29.9%. In today's video, we're going to go over a couple of moves inside the portfolio, talk about Jerome Powell's comments on Friday, go over the upcoming earnings week, and as always, a couple of market-specific data and company-specific information as well. So let's start off with a quick portfolio update. The companies here at the top remain the same. SoFi number 1, Google Alphabet number 2. We've also reached new all-time highs for Alphabet on Friday. Number 3 here is Nebius. Then we've got Rocket Lab, Micron, the local AMD, Uber, Cash Position, Alibaba, Meta, Duolingo is the only position now that is red in the portfolio. PayPal is now only 4% of the portfolio here, and that's because of the following thing. I sold 50% of my position, as I've explained last week and throughout the live streams. I sold the shares to buy call options, same strategy as with Intel. The ones I bought are $100 March 2026 and $120 January 2027. I'm still very bullish on PayPal, and I think reaching $100 before March is a big possibility. And of course, after Friday's comments, I think it is an even bigger possibility. Now, what did I also do? I did increase my Rocket Lab position by 10.8%, increase my Oscar position by almost 22%, and increase my Nebius position by just another 5.65%. And so this is why the portfolio looks like this right now. As for the call options, these are the call options, the Intel one and the two for PayPal. As you can clearly see that on Friday, of course, things were looking very, very nice. For Intel, yes, I was up more last week, but I'm still up 88% on those call options. For PayPal, both of them, I am down 2.2% and 3.5%. I still believe that this was the right move. Of course, the timing for Intel was quite perfect. And yeah, I was probably lucky with that one. With PayPal, I think the timing is very good for me to switch strategies a little bit. And of course, the timing of Jerome Powell's speech on Friday was also, well, very well received from my end. But yeah, this is basically the strategy for these companies going forward. Now, as for Jerome Powell's comments on Friday, what exactly happened? Why did the stock market go up so much on Friday? Is it purely because he said that rate cuts are coming? Well, let's go over a couple of details. So regarding the labor market, Powell acknowledged that the slowdown in payroll growth in July, along with negative revisions for May and June, was larger than expected. However, this has not yet led to a significant rise in unemployment or a worsening of wage growth. He described the labor market as weirdly balanced because both the demand for jobs and the supply of workers are slowing. This is partially due to slower rates of immigration. This unusual dynamic helps to keep the unemployment rate from rising, allowing the Fed to be more patient with its policy decisions. Despite the current balance, Powell warned that the risks to employment are skewed to the downside, and if they materialize, the Fed would be prepared to quickly adjust its policy. As for inflation, Powell confirmed that tariffs are now visibly boosting prices, as seen in the latest Producer Price Index, or PPI. This has led to a reacceleration in goods inflation, even as housing inflation continues to show solid disinflation trends. In a notable and market-friendly statement, Powell said he believes the price impact of tariffs will be short-lived. He distinguished this from the more structural inflation seen during the pandemic, arguing that tariffs should only cause a one-time step-up in pricing over a few months rather than a persistent ongoing inflation problem. The Fed is encouraged by the fact that long-term inflation expectations remain anchored, suggesting that the public does not believe the recent price increases will become a permanent feature of the economy. As for policy implications, Powell indicated that the shifting balance of risk may warrant an adjustment in the Fed's policy stance, This statement, which reflects a greater concern for employment risks than for inflation, led to a significant increase in the probability of a rate cut. The market's reaction was, of course, highly positive. And if we look at the probability of a September rate cut, it sits at 75% right now. Of course, a week ago we were at 85.4%, but a month ago we were at 58.4%. I do think that we're going to get a rate cut in September. Now, there are some talks already about how big of a cut. Is it 25 basis points or is this one going to be 50? I think it's going to be 25 now, and then we'll end the year with another 25, so 50 basis points cut for the back half of the year. What do you think? Well, actually, before you answer that, we also have a little comment from Tom Lee.
Good day to be a bull, like yourself, Tom.
Yes, it is.
How do you process what we just heard?
Well, I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps.
Small caps
and for equities.
They are working. Last I looked, small caps were up 3%. So is this what we need to really confirm the sort of broadening that comes and goes in the market?
Yeah, because I think that one of the things we should watch for is what happens to mortgage rates. But mortgage spreads are right now 360 basis points higher than the 10-year. Historically, it's 1.6 percentage points. So you could see a huge drop in mortgage rates. That's going to help housing, helps the financial small caps. And I think already the ISM, which has been below 50 for almost 30 months now, could finally go back above 50, and that's a good sign for industrial.
All right, we need to make some news here, Tom. Everyone listens to you. We're at record highs now for the S&P and the Dow. How much more can these stocks rally?
I think there's a lot of upside, especially because, once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think, towards the end of the year, 6,800, 7,000 is possible.
Tom Lee, of course, is viewed as the forever bull. But why wouldn't you be a forever bull? Right? If you look at the Nasdaq 100, you go back all the way to 1999, and you look at what has happened each and every year since then. Right? You can clearly see that there are way more green years than red years. Of course, the red years, as you can clearly see, 2000, 2001, 2002, that's 3 years in a row where you are losing almost a third of your value, one after the other. Then in 2008, financial crisis, you lose 41.7%. Then if we look here at 2022, you lose 32.6%. But of course, if you go and look what has happened after those huge red years, up almost 50%. Here, 2009, 54%. If we look at 2018, you're down 0.1%. And then the next year, you're up almost 40%. And here in 2023, of course, you were up 54% and then another 25.6% in 2024 after being down 32.6% in 2022. Of course, let's say you start at $100, you're down 50%, and then you're up 50%, you're still losing money. Unless, of course, you add it when it crashed 50%. That's the thing. It's never fun to lose 41% in a year, right? Hopefully we will never experience something like that. But when these things happen, when these huge corrections happen, that's usually when you will make your best investments, right? Imagine buying a bunch of stocks here in 2008, a bunch of the best companies out there. The returns today would have been incredible. Buying, of course, an Apple, an Amazon, or whatnot in the early 2000s would have made you a millionaire today. Of course, back then, it's never very enjoyable to start buying stocks when everything's crashing. But that's usually when you will make a fortune. Of course, you will need patience because, as you can see, you could have bought in 2000 or maybe in 2001 and say, okay, next year is going to be a good one. But no, next year you are going to get hit another time. Of course, this is a very specific period, right? The dot-com bubble, then 9/11. And so hopefully this will not happen again. But just so we're clear here, there are way more green days than red days or green years than red years. And of course, we know that when there is blood in the streets, that's usually when you should attack and buy a bunch of good stocks. Moving on to next week, we have a very, very exciting week, of course. Next week, we start the week off with Pinduoduo before the market opens on Monday. So probably Jose and myself, or just me, but Jose will listen. I will cover Pinduoduo a little bit before the market opens. Then Tuesday, after hours, we do have Okta, MongoDB, and Box. And then on Wednesday, that's the big one. Well, before the market opens, we have Abercrombie & Fitch. But after the market closes, we have, of course, NVIDIA. Not just NVIDIA, you have Snowflake, CrowdStrike, and HP as well. But yeah, I think we're going to stream the whole of NVIDIA on this channel with Jose. So make sure you have your notification bell on so you don't miss that live stream. I will probably make a preview video maybe tomorrow or something like that. And then on Thursday, before the market opens, Dollar General, Best Buy. Not that interesting, to be honest. But after the close, we do have Marvell, Dell, Iron, Ulta, SentinelOne, Affirm, and a Gap. I only own Iron here, and I think that's going to be a very, very, very interesting earnings report, and especially earnings call. And then on Friday, we do have Alibaba. Very strange that Alibaba reports on Friday, but you can expect an earnings recap from me on Friday about Alibaba. Moving on to some market data here. Another week, more all-time highs. Tuesday and Wednesday saw 80% of S&P 500 stocks go up. It's not the first time that this has happened. As you can clearly see, this has happened plenty of times. Of course, we are close to all-time highs, but then again, previously, not that long ago, actually, we were also close to all-time highs, and that has happened. Now, what will happen, or what has happened with the market when this has happened before? So the S&P 500, after 2 days with over 80% of advancing stocks, while the S&P 500 is at a 52-week highs. Of course, this has happened Wednesday, Thursday. So let's see what has happened a week, 2 weeks, a month later, maybe a year later as well. We do have some data points to work with, as you can see right here. And on average, the odds are with us, right? I think a week later, 2 weeks later, if I tell you that 69% of the time we were green, I think we'll take that. But then again, every period here is a bit different, and especially now, it's very, very different with, of course, high interest rates cuts are incoming, comments from Jerome Powell, still earnings season, especially with NVIDIA reporting. We still have tariff deals going on. So a lot of things can, of course, impact the performance of your stocks, the stock market in the short term. But all in all, we can see that the data suggests that we should continue to go up. If we look at the amount of stocks above the 200-day moving average or the 50-day one, that is also above 60% for both of them. As you can see, we have been much higher before. This is not something that has never happened previously. As for the fear and greed index, this is usually very, very useless, but just for information purposes, we are now in the greed part of it. I would have assumed that we would have been in extreme greed, but I guess once you have 3-4 days of a little bit of red, then this completely goes back to neutral or fear. Again, that's why I do think that this index here is quite useless. Now, something that you've probably seen pop up quite a lot over the last couple of years is this, the main stages of a bubble. And this is an open-ended question for you to discuss in the comment section. Where are we today, right? Where are we today? Of course, if you ask the perma bears, they would probably tell you we're somewhere here, right? We're somewhere near the top and a huge crash is coming. If you ask perma bulls, they would probably tell you we're still down here. I would say that normal, let's say realistic people might say that we're somewhere here, right? We've had the first sell-off, the bear trap, and now we're making our way higher and higher. Some might say that we're already here, maybe in enthusiasm, closing in on greed, right? It's a possibility? I think so. So what do you think? Where are we here in the main stages of a bubble? Again, with bubble, I don't like that word because yes, even today there are already some sectors, some specific companies that are in the bubble. I don't think the market as a whole, as I've explained in another video, which will pop up in the top right corner, I don't think the whole market is in a bubble. Are some names stretched? Yes, of course. Does that mean that it's a bubble? No. I think you have expensive, overvalued, and then bubble territory. Does that make any sense? I think. I mean, for me, it does. Last two things here. One is Intel related. US to take 10% equity stake in Intel. And I've seen a lot of people say, oh, this doesn't make any sense. It's a waste of money. Just let Intel die and move on. This is not a good investment. Well, first of all, let me remind you that the National Development Fund, which represents the Taiwanese government, is the single largest shareholder in TSMC. And I think that buying 10% of Intel today at prices that, in my opinion, are still ridiculous compared to the potential that Intel provides in the future, especially now that it seems like it's getting quite a lot of attention and quite a lot of money that is flowing in, because Intel is still very important to the semiconductor ecosystem. You will not convince me that a lot of the companies that use TSMC would not like to have another competing option out there, because more competitors means, well, pricing will be better. It just makes total sense. Second of all, or maybe third, Intel is a very, very important and valuable asset for the United States. Imagine when things will turn around and Intel Foundry does become a huge success in the future, a huge American success in the future. 10 years from now, you will look back and say, actually, that 10% stake in Intel at these prices was actually a genius move. They might say, yeah, but we don't want government to control companies. This is just a 10% stake. They will not have any say on how Intel should run its business. It might just support Intel, and yes, maybe they will say, look, company X, Y, Z, maybe it would be a very good idea for you to start investing in Intel as well, and maybe become Intel customers. Of course, at the end of the day, it's up to Intel to provide the best possible products, services, and technologies, right? Because otherwise, what's the point? Lastly, here we did have a post from Baidu with regards to Apollo Go. So they now have, as you can see, over 14 million cumulative rides as of August 2025, over 2.2 million rides in Q2, that's up 148%, and they're in 16 cities globally. Why is this important? Are you an investor in Baidu? No, I'm not an investor in Baidu, but I am an investor in Uber. And maybe you forgot, but in July of this year, Baidu and Uber joined forces to accelerate autonomous vehicle deployment. So they announced back in July a multi-year strategic partnership to deploy thousands of Baidu's Apollo Go autonomous vehicles on the Uber platform across multiple global markets outside the US and mainland China. The first deployments are expected in Asia and the Middle East later this year. After launch, if a rider requests a qualifying Uber trip, they may be presented with the option to have their trip fulfilled by a fully driverless Apollo Go autonomous vehicle. Apollo Go deploys an operational fleet of over 1,000 fully driverless vehicles globally, with its global footprint spanning 15 cities. That was back in July. Now it's 16 cities, including Dubai and Abu Dhabi. Like I said, Uber is the platform where a lot, if not most, of these AV players are going to list their fleets on. And so overall, to conclude, of course, I'm extremely happy with the portfolio, with the performance. Will I add more to positions? Yes, of course, if we do see some flash sales like we've seen the last couple of days, although now with the momentum, with the comments from Jerome Powell, with the incoming interest rate cuts, I don't know when that will happen, but I don't care. Whenever that will happen, I have my cash ready here in order to add when I see, well, interesting opportunities. And if not, like I said before, if not, then I'll continue to average up in names like Nebius, even Rocket Lab as well, because I do want to grow those positions. Same thing here with Oscar Health. And then with the options play, of course, I'll update you every single week. That's definitely more volatile and, well, a bigger risk, because if the stock does not reach the strike price, then yeah, there goes my position. But that's why it is a smaller part, and that's why with PayPal specifically here, I still own shares of PayPal straight out. As of adding new positions in the portfolio, I don't think I will be adding a new position in the portfolio anytime soon. I still have Iron, Applied Digital, and Open in the speculative gambling casino portfolio part. But truth be told, I don't even see Iron and Applied Digital as a bet or gambling move anymore. Open Door, 100%. I mean, I'm up 5x now on Open Door. Very, very small amount. I own 1,000 shares. But hey, if you're in the meme, then I guess just go with it until the end. If we go back down to $1, then whatever, right? Whatever. So anyways, that's about it for me in this video. If you enjoy this type of videos, hit all the buttons and we'll see each other in the next one. Bye-bye.